A multi-billion-dollar casino empire did not collapse because of declining demand or financial losses. It collapsed because something inside the system was allowed to exist for decades without interruption. Why is this happening? What is being hidden? Who is really benefiting when power operates without effective oversight? And more importantly, how long can a system absorb pressure before it is forced to act? This is not just the story of one man's fall. It is a structural stress test of Las Vegas itself. Stay with this investigation, because the surface story is only a fraction of what is really happening. If you value clear, data-driven analysis, consider liking this video, subscribing, and enabling notifications to follow the full investigation. On November 22, 1989, the Mirage officially opened on the Las Vegas Strip. The total development cost was approximately $630 million, making it the most expensive resort ever built at that time. The project was led by Steve Wynn, who positioned it not as a traditional casino, but as a fully integrated entertainment destination. The original vision was clear. Gambling would no longer be the primary driver. Instead, the resort would monetize experience, a tropical rainforest inside the property, a man-made volcano erupting nightly. Headline performances by Siegfried and Roy. This was not incremental improvement. It was a structural shift in how Las Vegas generated revenue. Within 30 minutes of opening, more than 40,000 visitors entered the property. In 1990, Las Vegas visitation increased by 16% year-over-year, one of the largest single-year increases in the city's history. The Mirage proved that large-scale capital investment combined with spectacle could reshape demand. At that moment, the model appeared highly sustainable, high upfront cost, but offset by massive foot traffic and diversified revenue streams. However, what was built in 1989 was not just a resort. It was a new financial framework for the entire Strip. And that framework still defines Las Vegas today. The original Mirage model was built on direct ownership. Mirage Resorts both owned and operated the asset, allowing full control over revenue, capital allocation, and long-term strategy. That structure began to change in 2000 when MGM Grand Inc. acquired Mirage Resorts for $6.6 billion, later becoming MGM Resorts International. For years, MGM maintained the traditional integrated model, but the real structural shift came in December 2021 when MGM sold the real estate of the Mirage to Vici Properties for approximately $4.25 billion. This was a sale-leaseback transaction. MGM retained operational control temporarily, but the asset itself was transferred into a real estate investment trust structure. In 2022, Hard Rock International acquired the operating business for approximately $1.075 billion. From that point forward, the Mirage became a split-structure asset. Vici owns the land and buildings. Hard Rock operates the resort under a long-term triple-net lease. This is where the pressure begins to build. Under a triple-net lease, the operator is responsible not only for rent, but also for property taxes, insurance, and maintenance. The lease includes annual escalators, typically around 2% or tied to CPI, meaning rent obligations increase regardless of performance. There is no flexibility. Revenue fluctuates. Demand shifts, but rent remains fixed and rising. This structure transfers risk away from the landlord and concentrates it on the operator. And over time, that creates structural pressure. The financial performance of the Mirage in its final operating years reflected a system still generating strong top-line revenue, but under increasing structural pressure. In 2022, MGM Resorts International reported that the Mirage generated approximately $2.1 billion in annual revenue, with EBITDA estimated around $400 to $450 million. On the surface, these are strong numbers. Revenue had recovered significantly following the pandemic disruption of 2020. However, the growth rate was uneven. Compared to 2019, revenue was up, but operating margins were tighter. Labor costs increased materially across the Strip. Energy and maintenance expenses also rose. EBITDA did not expand at the same pace as revenue. Visitor data shows a similar pattern. According to Las Vegas Convention and Visitors Authority, total Las Vegas visitation in 2022 reached approximately 38.8 million, still below the pre-pandemic peak of 42.5 million in 2019. Airport traffic at Harry Reid International Airport also recovered, but not uniformly across all segments. High-value international visitors were slower to return. Segment breakdown indicates that non-gaming revenue, including rooms, dining, and entertainment, accounted for a growing share of total revenue. This aligns with the Mirage model, but it also increases dependence on discretionary spending. The system was recovering, but not evenly and not without pressure. This is where the financial model begins to show strain. Once the Mirage transitioned into a sale-leaseback structure, the cost profile changed permanently. Under the lease agreement with Vici Properties, Hard Rock International assumed a long-term triple net lease with fixed rent obligations and annual escalators. That means rent increases every year, regardless of revenue performance. This is a non-deferrable obligation. At the same time, debt servicing remains embedded in the broader capital structure. The acquisition cost of $1.075 billion for operations must be justified through consistent cash flow generation. Any decline in EBITDA directly compresses coverage ratios. And then there is capital expenditure. A property like the Mirage, especially one undergoing redevelopment into a Hard Rock branded resort, requires billions in additional investment. Renovation, rebranding, redesign. These are not optional. They are required to remain competitive on the Strip. That creates a layered pressure system. Fixed rent rising, debt obligations constant, CapEx increasing, operating costs expanding. And revenue, while large, is not guaranteed to grow at the same pace. This is the key structural tension. The model demands performance, but the environment is becoming less predictable, and that is not a future risk. It is already happening. Margins are tightening, cost structures are rising, and flexibility is limited. The pressure is not isolated to a single property. It reflects a broader shift across the Las Vegas market. The Strip and the local market are diverging. The Strip remains heavily dependent on tourism, particularly high-spending visitors. Meanwhile, the locals market relies more on repeat customers and regional demand. These two systems are responding differently to the same economic conditions. According to the Las Vegas Convention and Visitors Authority, total visitation has not fully returned to pre-2019 levels in a consistent way. At the same time, average spend per visitor has increased. Fewer people, spending more. That creates a fragile balance. Airport traffic at Harry Reid International Airport has recovered, but international travel remains uneven. High-value segments are more sensitive to global economic conditions. At the same time, competition is expanding. Online gambling continues to grow across multiple states. Regional casinos are capturing demand that once flowed exclusively to Las Vegas. International destinations are investing heavily in integrated resorts. And macroeconomic pressure is building. Interest rates have increased since 2022, raising the cost of capital. Inflation has affected both operating costs and consumer behavior. The market is not collapsing, but it is shifting. And that shift introduces uncertainty into a model that depends on consistency. This is the contradiction at the center of the Mirage model. Revenue remains high. In some cases, it has even exceeded pre-2020 levels. Average spend per visitor has increased. Room rates on the Strip have reached record highs during peak periods. But at the same time, structural pressure is intensifying. Fewer visitors are carrying more of the revenue burden. Costs are rising faster than revenue in key areas. Fixed obligations, especially rent and capital expenditure, continue to increase regardless of demand. On the surface, the system appears strong. Underneath, margins are being compressed. This is the paradox. Growth is visible, pressure is hidden, and that is what makes it dangerous over the long term. Because a model that depends on fewer customers spending more is inherently less stable. Any disruption to demand has a disproportionate impact on revenue, and when fixed costs remain unchanged, even a small decline can create outsized pressure. The system is working, but it is also becoming more fragile. The Mirage is no longer just a property, it is a case study in how modern Las Vegas operates under pressure. A billion-dollar asset separated into real estate and operations. A long-term lease with fixed and rising obligations. A redevelopment plan that requires additional capital at a time when costs are increasing and demand is less predictable. Nothing here suggests immediate failure, but everything points to a long-term stress test. Because the central question is no longer whether the Mirage can generate revenue. It clearly can. The question is whether that revenue can consistently outpace the structural costs embedded in the model. Rent that rises every year, debt that must be serviced, capex that cannot be delayed, and a market that is shifting. This is not about one property. It is about whether the Las Vegas model, built on scale, spectacle, and continuous reinvestment, remains sustainable under these conditions. The system is still functioning, but the test has already begun. If you found this analysis valuable, consider liking the video, subscribing to the channel, and enabling notifications to follow future investigations. You can also explore our related breakdowns on other Las Vegas properties and structural risks across the Strip.